Right, live with Bloomberg Quint at the Morgan Stanley Investor Summit in conversation with Jonathan Gardner. Needs no introduction. Joins us right now to speak about his thoughts on what's happening with the world equity markets. Well, just after the RBI policy as well, which has happened in India,
yes.
and I believe after a very successful 2 days of the conference. What was the mood like? Were clients falling over each other to go out and buy India?
Well, I think people have already been buying India this year. The market's had a good year. It's not unique in emerging markets in having that, but there's a good cyclical story to tell here, we think. We think that we're on the cusp really of what my colleague Chetan talks about, the economy firing on all cylinders. So export recovery, consumer moving forward, and actually hopefully then even moving towards a private capex cycle.
Yeah. So Jonathan, I was looking at your comments last year as well, and of course the scene is quite different. But last year, if I'm not wrong, you guys had an overweight on India somewhere around April, May, if I'm not wrong. And one of the reasons was that India and certain other markets had underperformed compared to a few others, and there was a great gap to move up. If I looked at the YTD performance of Indian markets, if I look at 1 year performance, I think all markets, Asia Pac, are even Stevens. But if I look at YTD, India has significantly outperformed a bunch of other markets. Is that not a potential hurdle if you look at India vis-a-vis the others?
So we run a process where we try to assess 27 countries against each other across a range of quantitative factors, and then house inputs on the macro side or political risk analysis.
Right.
So if you look at the valuation buckets, the forward PE premium is pretty close to long run average levels. It's a normal valuation premium on that metric. However, the dividend yield and dividend payout for India have improved significantly relative to the rest of EM, which is interesting. And versus some of our underweights, the return on equity has held up much better than, for example, places like Australia or South Africa, which had a big drop-off in ROE. So in terms of the earnings, though, India's earnings have not come through as strongly as, for example, has happened in the case of China. So there are bits of the jigsaw puzzle that have yet to fall into place, but hopefully the actual earnings revisions will pick up with the macro story that I just mentioned, our economists believe in. And then we should get some further performance from India, but not as much as the last 6 months. If you look at the Sensex target, 34,000, and our rupee view of 63 to the dollar, it stacks up to round about sort of high single-digit dollar returns, whereas we're coming off like more than 20% year to date.
We are. The only thing is, so if I look at your, I think I read about your comments, which you must have given yesterday as well, wherein your valuation parameters, one is that now you're choosing to look at price to book as opposed to say certain factors like EV, EBITDA, which is looking stretched, but your price to earning assumptions for India 1 year forward, I think are at 16.5. If I look at the Bloomberg estimates, they're about 17, slightly over 17.5, close to 18, which probably leads me to believe that you guys are a lot more optimistic about the earnings recovery happening in a big way in FY18 compared to maybe the street.
Yeah, we are more bullish than consensus on earnings for India, so we expect high teens earnings growth for the March 18 financial year ending. But actually that 16.5 forward is a target forward P. It's where we think forward PB will be a year from now. If we look at EM overall right now, it's trading on our earnings numbers about 12 times forward, and our earnings numbers, India's trading round about sort of 17 and a bit.
Pretty much at par. Aside of India, what other markets do you think probably present an equal or slightly less than India opportunity? And would fund flows be any problem for a country like India? I mean, would funds get distributed, or do you believe there is just enough liquidity globally? We'll come to the local part as well, but you believe there is enough liquidity globally to satisfy the appetite for almost all the EMs?
Well, we've had about $35 billion of fund inflows to EM equities year to date. That is a strong year. It's not sort of the strongest that we've ever seen, but it's a very strong year. And most of that's coming in ETF form. So a good like 80% of that is an ETF. So India gets its share of the passive ETF money, the EM tracker. It's about a 7% weight in that. So it's not the largest market, that's China, and there's also larger weighting in markets like Korea and Taiwan. So those flows typically have some seasonality. They tend to drop off in the summer, and so maybe we should be expecting that. But overall, our view on equities is very strong earnings growth globally this year, and allocation for us still makes sense out of bonds and into stocks, given our view of a synchronized global expansion. So I think, again, coming back to what I said about the target returns, we're exiting the period when flows are typically strongest. We're going to a more difficult period for the next 4 or 5 months, but there's still more to play for.
Does the domestic flow story aid that picture? Because
Yes.
until 2 years ago, it used to be majorly dependent on foreign flows, probably still is, but domestic flows have made a real strong move in the last couple of years.
Yes, and one of our other key overweights, China, also has that characteristic, particularly shifting through the Connect program from mainland China to Hong Kong.
Right.
But in India's case, it's all related to much better macro balance. So inflation is far more under control than in the past. The current account is essentially balanced. We've got a much lower fiscal deficit. And so those 10-year bond yields have come into whatever they are, 6.5 or so. They maybe have further to fall. And that sets up a very good sort of bond yield, earnings yield story for rotation into equities. So yeah, you're absolutely right. Those domestic flows are a really important reason to be bullish still.
Okay, the last couple of questions, Jonathan. One is, I was looking at, again, some things that you must have spoken in 2016. I don't know if you remember all of those or no, but one key reason, if I'm not wrong, for your upgrading India in 2016 was also that the low beta nature of the market. So on technical factors like beta, volatility we know is right now trading at multi-year lows, so to say. How does India stack up?
Well, India actually used to be a high beta market. And certainly in the taper tantrum in 2013, it was one of a group of countries that were quite vulnerable. At that time, the current account was far more of a constraint than it is now. But actually, over the last 52 weeks, India's become a low beta market. Its beta to the EM index is well below 1. So that's actually quite an attractive characteristic. It's related to the better macro situation. Yeah.
Okay, how vulnerable could the Indian markets be to a pause in global liquidity? I mean, considering we're talking about how strong the domestic flows are as well, if indeed due to a global event, uncertain, which we don't know about right now, how vulnerable could that be?
Well, I talked about the direct form of liquidity in terms of fund flows, but if I was to try and sort of look at your question another way, it'd be around the Fed. Okay, so the Fed ultimately sets the global discount rate. If we're right, the Fed moves reasonably slowly, and the 10-year bond yield in the US is range bound between 2.2 and 2.4 or so. If we're wrong and the Fed is more aggressive and the 10-year yield in the US goes up, say, to 3%, that makes the reduction in those Indian bond yields that I talked about earlier more difficult. So ultimately, the global cost of capital is something that warrants observing. But over recent months, it's been quite advantageous from an EM perspective. The 10-year bond yield's been flat to down, and that's been associated with the dollar being very range-bound, the US dollar. And that's quite a good environment for emerging markets. Yeah.
Okay, final question, Jonathan. Let's look at the other side now. What's the case for you being surprised positively? I mean, is there, because you guys are amongst the most bullish on the street, is there a chance due to earnings or otherwise that your assumptions of earnings and the GDP growth and India could actually surpass both of those?
Well, I mean, let's see. I mean, there is, of course, a chance. We have, formally, we do bull case scenario analysis as well as bear case scenario analysis. It could happen, but I think we already have this view that earnings are going to recover quite strongly, and they haven't come through yet.
Yes.
So I would caution against getting too optimistic.
Yeah.
We are coming off a very strong period for returns, and but we think India is definitely an overweight, along with China and Malaysia.
I was chatting with Ridham yesterday and asking him the same thing, that for the last 2-3 years, analysts have entered into a year thinking that we'll get earnings growth of 15, 18, 20%. In India's case specifically, we've been kind of had to revise it downwards. What's the reason why this year could be different? And
so there's some very specific shocks that hit late last year: demonetization, the problem around global trade that was going on in late 2015, and then actually the fiscal tightening that was done early on in the Modi administration that was needed. But we think we're exiting that period now, and we're poised for a synchronized recovery across many sectors in India.
Okay, one last thing. For EMs by and large, Jonathan, do you think the growth could well be external-led, exporters-driven growth? Because we are seeing, as you mentioned as well, global economy recovery, and therefore the export demand for a lot of EMs could be strong as well. Would that be a key
India
factor?
is not an extremely open economy, but it certainly is geared to that. Yes, if you go and look at, for example, late 2015, early 2016, global trade was actually shrinking. And now it's poised to be growing faster than overall nominal GDP growth, and some Asian countries are already reporting 15-20% year-on-year export growth. So that does bode very well. Yeah.
Great. Jonathan, thank you so much for your bullish comments and your openness, quite frankly, with your views. Much appreciate you talking.
Thanks for having me. Thanks.
That's Jonathan Garner of Morgan Stanley.